been another busy week in the news and in the world of finance. I suppose one of the biggest news stories of the week has been some of the central banks have decided to hold interest rates where they are, with a lot of commentators predicting that now we're going to see interest rates rise, despite we're being on quite a nice trajectory of rates falling. Just give our viewers a little bit of an overview into why this is happening in the context of Iran and what you anticipate is going to happen over the course of the next weeks and months.
Yeah, it's very disappointing and supremely frustrating for anybody who wants to try and find a new mortgage at the moment. What's happening is that since the invasion of Iran, we have seen energy prices shoot up, both gas and electricity. And this week, we've seen another escalation in the conflict, with Israel hitting Iran's gas fields and then Iran retaliating and yet again hitting infrastructure in Qatar, which is responsible, the Ras Laffan gas plant, responsible for supplying around 20% of the world's liquid natural gas. And that is why you saw gas prices rocket up on Thursday to really high levels, up 35% in a matter of hours. Now, they have come down a bit, but they're still around 10% higher than they were on Wednesday. And this, of course, was the day before the Bank of England made their decision on interest rates. So it really wasn't a surprise that interest rates were kept on hold. And the governor, Andrew Bailey, said that the bank was standing by to act if it appeared as though inflation was going to become much more problematic. So no rate increase for now, but the financial markets are pricing in a couple of one or two rate hikes now before the end of the year. And yes, inflation did look like it was on a downwards trajectory. That was why more interest rate cuts were expected. But now the bank is predicting that for March alone, instead of coming in at 3%, inflation is likely to be at 3.5%. And the big worry for the bank is that if consumers have to pay more, and in particular, if companies have to pay higher energy bills, they will pass on those costs in terms of higher prices for goods and services. And that is what the bank will be really worried about. Not just this initial spike in energy prices, depends on how long it continues for, but whether it lingers and then you see prices rise right across the economy.
We've also seen today gilt yields have hit 5%. This is 10-year gilt yields have hit 5%. I think it's the highest rate since 2008. If you can, try and give our listeners a little bit of an overview of how these things are interconnected, because I think a lot of people got their head a little bit around gilts around the time of the Liz Truss mini budget. But maybe people don't quite understand how all these things are interconnected and how inflation is impacting interest rates, that's impacting gilt yields. And is this a bad thing for UK voters and retail investors?
Yes, it is also pretty worrying, because we have seen these gilt yields spike to levels not seen since 2008. And the reason for that is because of those inflation expectations, the forecast that inflation is going to get higher, and as a result, the forecast that the Bank of England will be forced to increase interest rates rather than decrease interest rates. And so that's what's showing up in financial markets, and that's pushing up the interest payable essentially on government debt. So these gilt yields, because they move in tandem really with interest rate expectations in the market. And so that is what you are seeing. And then it could be compounded by the fact that it, of course, increases government borrowing costs. And if it's even more expensive for government to keep borrowing money, that makes their situation, the public finances situation, even worse. And that in turn leads to a bit of a lack of confidence among bond investors, those gilt investors who we rely on to finance our debt. And that means they might sell off that debt, which then pushes the yields up even higher. So you can get into a bit of a vicious circle. Another reason why you saw gilt yields rise today is because government borrowing figures came in February higher than expected. And that led to a little bit of worry as well. But mainly, it's not the government's making here. It is the fact that it's super sensitive to what's happening on global markets. And that is the situation that the government finds itself in. And unfortunately, because of that, it could be that we might even see tax rises, because what Rachel Reeves, the Chancellor, wants to do is try and keep those gilt investors on side as much as possible, and not see them selling off UK government debt and going elsewhere, because they don't rely on the government to have a steady hand on the tiller, essentially. So it could be that consumers will be faced by this double whammy of rising energy bills, rising mortgage costs, and potentially further tax rises. Now, it all does depend on how long the energy shock lasts for, how long these wholesale oil and gas prices remain elevated. The problem is, right now, President Trump and the US administration appear to be sending more troops to Iran. On one hand, you could read that in, they want a swifter resolution to the conflict. On the other, that the conflict is becoming more entrenched. So it is really wait and see mode for governments, for central bankers, for us consumers, to find out what twist we could see next.
So what do we do? Because there's lots of people, particularly on the political right of this country, saying we need to start drilling for oil in the North Sea and exploiting some of the natural resources we've got. I think that comes with its own issues. There's a lot of kind of new green tech that appears to be coming out, and lots of kind of new startups and early stage company that appears to have some solutions this on the renewable side. What would you say, like, if you were sat in front of Rachel Reeves and Ed Miliband now and go, look, how are we going to not only get ourselves out of this issue now, but also secure our energy security long term? What options do we actually have as a country?
Well, it's not really easy to say, let's just drill for more oil and gas. It takes 10 to 15 years to really undertake a project of that scale. You could have said in hindsight, we shouldn't have closed the gas storage facilities so readily, because then we would be able to have a more of a ready supply in terms of an emergency. On the other hand, we do need to invest much more in renewables, but that again is a longer term project, but around a similar time as drilling for more oil and gas, or creating the better infrastructure and networks for renewables. Ultimately, renewables are the cheapest source of energy that we can pursue over the longer term, and it also removes us from the much more volatile fossil fuel markets that we are currently experiencing. We saw this, didn't we, with the war in Ukraine, when that erupted and gas prices rocketed. We're vulnerable because even though actually we are generating a lot of electricity through renewables, we have a marginal pricing system, which effectively means that the overall electricity price is set at that last unit that is needed to ensure that the lights stay on and that the grid is operating. And that last unit is gas, and that's why we're paying these really high prices. If it were anything, what I would do is try and change this marginal pricing system so that we're not reliant and all of us don't have to pay such high costs when gas prices alone shoot up, because it is cheaper still to get electricity from renewables, but it's not even the cost that we're paying. So I would try and tinker around with the system, using perhaps contracts for difference, and that there are different systems available. The problem is with some of them is that you might have a slight greater risk of not having enough electricity generated. So there are drawbacks with other systems, but perhaps it should be a mix and match approach. And I think that's what should be looked at, because that will mean that actually consumers will be more on board shifting to renewables, because they could understand that actually they're paying a lower price for renewables. It's gas that is making our bills so much more expensive.
Do you think there needs to be a bit of a step in from the government? Because a few years ago, they had some tax incentives to get people fitting their own solar panels and their own batteries and things like that. Do you think anything like that as a little bit of a short-term fix, maybe for a year, 18 months, would relieve some of the worries that consumers have?
But it's very difficult, isn't it? Because actually the government is being called on to spend money everywhere, spend money in helping people with their high energy bills, spend money on the National Health Service. I mean, it's tricky. And actually it can't spend too much money, because then borrowing costs will go up again, because bond vigilantes, who essentially those bond investors, the gilt investors who we rely on to finance the UK, we've got to keep them happy as well. And actually, if you're too flash with the cash and offering subsidies everywhere, you're not necessarily going to do that. So it's not as easy just to say, just start subsidizing everything. I do think that this energy shock may mean that more homeowners will look seriously at getting solar panels, but again, you've got to make sure that they can benefit from that system, and that actually it's going to be worth their while over the longer term. I'm pretty pleased that I've invested in an electric vehicle, certainly right now, and I think it will help the green shift. This is what we need. I was in Norway at a big energy conference this week, a big shipping and energy conference, and there is a real hope that there will be this accelerated shift to renewables, because it will make us less kind of beholden and less at risk from these very volatile prices. But of course, we do need significant grid upgrades. We need stable forms of renewables. We need a lot more investment in battery technology. Chinese are already investing heavily in that, and that these advancements will come and filter through into our economy as well, to make it cheaper for us to invest in renewables. So it's progress, but on the other hand, I think there are other investments that the government should be making, which is into nuclear power, should make up a bigger part of our energy system. France has a much more of a reliance on nuclear power, and the bills there do not go up like we have seen or bracing for here in the UK. And in Norway, for example, where I was this week, the economy is powered mainly by hydroelectric power. They're much more ahead of the times in terms of renewable energy. Pretty much everybody's got an electric vehicle, and it means that they pipe a lot of their gas to us. Instead, we're still reliant on gas. They just aren't.
We're in a really unique situation in the UK where we have all these opportunities to have a really diverse energy makeup. I know that Ed Miliband earlier this year looked to, I think he awarded some contracts for these modular nuclear
small modular reactors.
Yeah, which again the French use very successfully. We have obviously we have rivers that have a very strong kind of tidal pattern that we could use hydro for. We have lots of space that we can use solar for, and we also have gas and oil reserves. And it feels like it's been successive governments of sticking plasters, and actually the underlying technology and infrastructure that the grid that we all needs such a revamp that it feels that anything we're doing right now just feels very, very short term. But I don't know if this is a product and a byproduct of successive underinvestment and successive governments.
We should have accelerated it more, but there is certainly a lot of investment going into grid upgrades right now. And part of the reason why energy bills are so expensive is because we are paying for the green transition. So it's paying now for hopefully a more stable future. So yes, of course, more should have been done. In fact, in France, it's the large nuclear reactors that have been so instrumental in creating stable flows of energy. Right across Europe, though, I host the Nuclear Energy Forum, the Europe's Nuclear Energy Forum, every year, both in Bratislava and in Prague. And lots of countries across Europe are looking at introducing small modular reactors. But again, it's kind of, the plans are afoot. The government here in the UK, it's running a pilot project. It's funding. Rolls-Royce actually won the funding for its small modular reactor program. So there is progress there as well. And I think what you're seeing with this energy shock is that there's going to be more of a concerted effort to put more money in. Wealth Club investors, I currently work for Wealth Club, which is an investment platform, and we ran a survey among our investors earlier in the year. And even though because interest rates were high over the past couple of years, there did seem to be a bit of a drift off away from green investment. Actually, among our clients, there's a real interest in investing in renewables. And these investments, they are still capital is still flowing in, may still not be completely flavour of the month, but I do think that there is great interest going forward.
We just touched on briefly the how governments, and particularly this government, can't spend money on absolutely everything. But there are some initiatives that it does give tax incentives for, and schemes like the Enterprise Investment Scheme. How important do you feel that these investment schemes are into those maybe slightly riskier or early stage companies, particularly those that are actually trying to tackle some of these really big questions that we're trying to solve as a society, such as whether that be the green transition or technological challenges of AI? How important do you feel that these investment vehicles are to accelerate UK companies into solving these challenges we have?
They are very, very important. So these schemes are designed to give tax incentives to investors to invest in startups and scale-ups in the UK. And they could be the future growth engine for the UK economy. And that is certainly what we want. We need capital to flow into these companies, and we need that capital to come from investors who have the money to spend and take the risk. I think the problem is, if you look at the main stock market, what you're seeing increasingly is a lot of investors are putting their money into passive investments that track the global stock market. And so really it flows into the United States primarily because the United States is so dominant on global markets. So even if you might be investing in a passive global fund, actually your money is really flowing into handfuls of companies. And as a result, companies listed on the London Stock Exchange are actually losing out. There's less money being ploughed into, say, FTSE 100 trackers, for example, in funds that track the UK stock market, and also into individual companies, and particularly into the AIM market, the alternative investment market, companies on the AIM market as well. So what you really do need is this incentive to ensure that money flows into these startup and scale up companies. If you don't get that funding and you don't get enough money flowing, there's less chance of having the UK stars of the future to compete in any scale with the might of American companies. So it's absolutely vital that funding comes through, which is why there are these tax incentives. So for the Enterprise Investment Scheme and the Seed Enterprise Investment Scheme, you can get between 30 and 50% income tax relief up front if you invest in these schemes and support these smaller companies. But you have to remember the reason why you do get that relief is because it is a risk. It's more riskier than investing in larger companies. It is a real shame that actually the relief available for another investment scheme, venture capital trusts, that relief has been reduced. And it's been reduced from 30% to 20%. And that is a real shame because actually these companies are a bit bigger, but they're still scale-up companies, still absolutely vital for the UK economy. And it would be good if the government rethought that, because you certainly do need that money to flow into those scale-up companies to really try and revitalise UK growth, because we certainly need it at the moment.
The House of Lords voted down the pension reforms that Rachel Rees and Torsten Bell have been trying to push through, which is to get a set amount of capital in pensions held in UK companies. We've obviously then got a big debate there, which is how should the government basically be telling you to invest your pension versus, trying to encourage people to invest into the home economy, and particularly to companies that are listed on UK markets. What's your view on that? Because I'm torn, because I think it's a inherently good thing they're trying to do to promote funds going into UK companies, but should there be quotas?
I think it's very difficult to suddenly have quotas, because let's remember the other element to this is that pension funds, they have to try and do the best for their members. And it means that they have to make sure that they are getting the best returns that they think they can get. So they've got this other, core aim, which is to ensure that people are financially resilient in the future. And so I can see why they have resisted. And instead, I think there perhaps needs to be greater opportunities and start more at the grassroots to enable these companies to build more easily and grow on the stock market. And then these pension funds will think, well, actually, they're really good companies anyway, I want to invest in them. So it's not, rather than mandating you must invest in these companies. It was a bit like the idea for a British ISA, where the idea was that you could have potentially a bit more in your ISA allowance, or alternatively, you'd get a reduced allowance unless you solely invest in British companies. But the problem there is that actually what you need to make sure is that portfolios are very well diversified, and you don't want people concentrating all of their portfolio on just one geography, because the tax incentive is there. What would be good though is if you get more wealthier investors who have already got very well diversified portfolios, to nudge them through tax incentives to invest in UK startups and scale-ups, because they have the extra money that they can take the risk with. The problem is with a lot of people who are reliant on pretty small pension pots, they haven't really got the capacity to take the risk, and they wouldn't want their pension funds to take the risk on their behalf, because already they will feel that they are not resilient enough for the future because their pots aren't big enough. So they would want their pension funds to ensure that they are getting maximum returns as possible. So you can see the dilemma for pension funds.
There's about, I think it's 75% of all money held in ISAs is in cash ISAs, and do you think this kind of all boils down to the fact that actually as a society, we are not as prone to investing as, say, the US is? We are more of a nation of savers. Do you think that's an issue as well?
Yeah, we certainly are more of a nation of savers. And I think it's to do with confidence as well, confidence in investing, understanding a bit more about risk, that it's actually riskier for your money longer term to leave your cash in a very low paying savings account, a current, or a current account. Even people do that, paying a minimal amount of interest, because the way inflation works, your money will really reduce over time. Whereas actually, if you'd invested it over the longer term in the stock market, despite all the volatility that we currently have and have had periodically, your money has historically been proven to grow a lot faster, and because of the nature of compounding. If you can reinvest dividends, and then that money that you reinvested, that grows as well, you can actually see a massive difference in your investments over 10, 20, 30 years, compared to if you leave your money languishing in a low interest savings account. And that's the kind of concept of risk really does need to be understood. But let's remember there are differences as well between the UK and the US. In the US, of course, student loans, they're pretty ferocious in the UK right now, but historically they've been much larger. And so people have been saving for their children's education in the stock market for longer. And also there's a kind of less of a tradition of pensions in the same way. And also remember, as far as the National Health Service is concerned, we are super lucky with the health service that we have compared to the United States, and people do tend to save and invest a bit more to protect themselves, particularly in later life if they have big medical bills to pay. So there are differences, of course, in the societies as well.
Obviously, the people that you're speaking to most at the Wealth Club are going to be more sophisticated investors, those who have been invested for a number of years, have more investable assets. But to get more sophisticated investors, we're going to need a kind of groundswell of more grassroots retail investors who get started and maybe haven't come from that investing background. What if somebody came to you and said, look, I've never invested, I don't know anyone who does invest, I want to get started? Any kind of tips, tricks, advice you would give to someone who just wants to get started?
Well, first of all, you've got to make sure that you're in the right position to get started, because you might want to invest, but actually your finances might not be in a good enough shape to invest. So you have to make sure you've got 3 to 6 months of essential expenditure in an easy access savings account. Then you've got to think, can I lock my money away for 5 years or more? And this is absolutely key. Some people think, well, I've put my emergency savings to one side, I can now start investing, but they might need to pull that money out within 5 years for a house deposit, for example, or to go on that holiday of a lifetime. And then their money can be hit by a bout of market volatility. And so that is risky. So what you should do is make sure that you understand what your investment horizons are. What are you investing for? When do you want the money? When do you want to spend it? If you're investing, for example, like a pension, and you're moving towards retirement age, then you should also think, well, if I need my money within 5 years, I should move my money perhaps out of equities to something a little bit less risky. So it does depend on what you want to invest for. But once you've thought, okay, I can put my money away for 5 to 10 years, then the best thing to do is to start looking at funds. Funds are like the gateau investments of investments. So in a fund, you've got lots of different layers. You could have equities, so a slice of ownership of companies, and then you could have bonds. Essentially, you're investing in government debt, which gives you like regular payments. But then you could have, as well as part of that fund, even gold and other commodities. So a fund gives you that ready-made diversification. And what you should do is look at a number of different funds to start off in your investment portfolio. What people tend to do is think, right, now I'm ready to invest. I'm just going to invest in some companies that might have caught their eye. They've heard a lot about them in the news, but actually that is risky because you're not spreading your risk across the market enough. So you need to think about funds first, and then those shares, once you've got your nice portfolio of funds, those shares then like kind of cupcakes around the side of the gateau, and then invest in them. But they might be companies that you think that you like to keep an eye on. You can watch the stock price rise and fall. But the most important thing is that you are in it for the long term, and really go for quality companies at a good price. That's not necessarily cheapest companies out there, or that you want to look for quality, and then lift the bonnet on the funds, look at what's in there. And again, I said a little earlier that you've got to make sure that you are well invested and very well diversified, because you might think that you've invested in a fund which is a global tracker, so it tracks a number of different indices around the world, but actually, because of the weight and the sheer size of, say, the Magnificent Seven tech companies in the United States, you may find that your global tracker fund is actually made up mainly of US companies, those Magnificent Seven, and you're not actually that well diversified. So you've got to open the bonnet and look at those funds. That's the kind of DIY approach. You can also go on to one of the investment platforms, and you can opt for an adventurous style investment or a more of a conservative style investment, depending on how long you want to be invested for and what your risk appetite is. And actually, those types of funds will be picked for you. So the most important thing is taking that first step. And also remember to use your tax wrappers. So if you're investing in the stock market, do it through that stocks and shares ISA, and not through a general investment account. Because obviously anything you make within that tax wrapper, you won't have to pay tax on.
And then finally, give me your 60-second pitch.
Well, you can follow me on Instagram. I'm at Susannah Shares. I talk about the stock market an awful lot and what's happening on financial markets and what it means for your money. You can also follow me on LinkedIn, just my name, Susannah Streeter. I am on X, but I don't delve that regularly. But it might be worth as well checking out the Wealth Club. A really interesting part of the market is private markets. If you are a sophisticated and more experienced investor, you can not just help support those scale up and startup companies, but also you can invest in private equity. This is a real change that has come along in the last couple of years. But for as little as £10,000, if you've got that money available, you can start buying into a private equity fund in private markets, where there has been quite a lot of growth recently. So that's also worth an investigation.